Welcome to the SEEP Network's national webinar, How Behavioral Predispositions Can Influence Investment Committees. We remind you all, friends, to be proactive but thoughtful, to stay connected, and to seek opportunity. To begin, let us pray. O Holy One, you are our comfort and strength in this time of crisis. Surround us with your grace and peace. By your Spirit, lift up those in distress, sustain those who administer, strengthen those who steward, and fill us with the hope of your new creation. Through Jesus Christ our Lord. Amen.
Amen.
We're fortunate today to have two leading financial experts during our time, so let's get them introduced. An encore from our friend at Morgan Stanley, Joe Matthews. Joe is Senior Investment Management Consulting with Morgan Stanley Consulting Group. He's an expert in addressing the needs of institutional clients. Joe's been recognized in many places, including Endowments and Foundations magazine, where some of you may have seen him recognized for his body of consulting work. Joe is a frequent presenter at SEEP in the finance track, and we're fortunate to have his talent and voice as we help our members learn to navigate choppy waters. Joe holds the prestigious CFA charter and is an adjunct professor in behavioral finance and economics, which is the topic for today's webinar. Joe and his team at Morgan Stanley partner with other institutional consultants throughout the country. Welcome, Joe.
Hello, Deirdre. How are you?
Bob Schmidt is manager of Brandis Institute and joins us today from sunny San Diego. Bob is a frequent presenter at institutional investor conferences as well. He oversees research and analysis for the Brandis Institute, which is a think tank that helps the investment community's understanding of market behavior and portfolio management. He is also a lecturer in the Master of Finance program at the Rady School of Management at the University of California. Bob earned an MA from California State University in San Marcos. His investment industry experience began the same year mine did, in 1990, and he joined Brandis Investment Partners in 2000. Welcome, Bob.
Thanks very much.
We're very happy to have you both with us today. Just a housekeeping note to our attendees. First of all, thank you for being here with us, and we will collect and coordinate your questions in the chat. So please enter your questions in the chat portion, and we'll get to that during the question portion of this webinar. Joe and Bob, it's such a dramatic time, and we know sentiment can change quickly. We also know that psychology influences the behavior of investment committees. While we would all like to think that we are rational and objective as fiduciaries of Parish assets, you two are going to help us acknowledge that there may actually be some biases that may limit our best thinking. And you're also, we hope, going to point us to some tips for more successful decision making. Joe, there is great interest in behavioral finance, and it seems to be a key part of an economics education. What is it?
So going back to classic economics, Deirdre, there was a term called a homo economicus, and that's a Latin term, and after 5 years of Latin, I forgot every other bit of Latin except for those two words. And what it said, what the meaning of those words are in Latin is the rational person, the person who has a rational thought process that creates rational outcomes with the decisions that they make. Well, in the 1930s, John Maynard Keynes, who has a whole body of economic work named after him, said that most economic decisions are in fact made rationally, but that animal spirits are the reason why the economy goes up and down and the market does as well. And that was kind of the beginnings of behavioral finance. And lo and behold, fast forward to the late 1970s, there are two professors who are researchers by the name of Dan Kahneman and Amos Tversky that studied making decisions under risk. And this is something that Bob's going to go into in detail a little later on, was something called prospect theory. And that was the basis for the whole field of study to springboard off of, and it's never come back. And behavioral finance, frankly, flies in the face of classical economics, because the reality is, as human beings, we are all subject to making irrational decisions based on poor information, bad, not enough information, whatever the case might be.
Thank you. Thank you for sharing that. Bob, I'm going to pull up some of your slides that might be visual aids to help us follow along with you. I'll let you pick up here as well and talk to us a bit about your definition and understanding of behavioral finance and why we need to have an understanding of it.
Well, I think it's critical, as Joe mentioned, our emotions sometimes cloud our decision making. And over the years, researchers have come up with hundreds of these biases that can short circuit our investment decisions. We don't have time, obviously, to go through hundreds. We're going to focus on a handful that we think are the most insidious. So we want to raise awareness of them and then also share some tips and tactics that we can use to guard against them from affecting our decisions.
There's so much news and information. Some say bad news is good information. Some say there's too much information. Bob, can you comment on this information frenzy that we're experiencing during this economic crisis?
Yes, and with these headlines, I pulled up a handful that have appeared in the press over the last several weeks. And you can see, not surprisingly, that the press plays on two emotions, fear and greed. And what's amazing to me about these headlines is just two things: how much they prey on fear and greed, and two, if you look at the dates, how close together they are. In the last several weeks, the press has said, oh, the markets are going to plummet to zero. And then a few days later, this is a once-in-a-lifetime buying opportunity. So if you feel a little bewildered by what's happened in the markets and the financial press's coverage of that, you're not alone. And maybe Deirdre, maybe go back and let me talk a little bit about something called recency bias, which basically says we tend to overestimate the severity or frequency of an event based upon recent exposure. So if you're watching the news a lot, that recency bias can really kick in. And that can trigger some other biases. But my one tip here would be there's a balance between staying informed and overexposure to the news. So I would suggest watching maybe in the morning and in the evening and not watching the financial news all day long. It's just likely to trigger some of these emotions that can adversely affect our decision making.
Thank you. And I think you actually have some advice for us a little farther down to not even check things on a daily basis at this time and to take a monthly, quarterly, or even more episodic approach. Talk to us a bit more about prospect theory.
Yeah, Joe touched on this. Won Danny Kahneman a Nobel Prize in economics. Pretty amazing when you realize that Kahneman is not an economist, he's a psychologist. But basically, in its simplest form, Kahneman argued that losses hurt twice as much, at least twice as much, as comparable gains feel good. So if we lose $100,000 in the stock market, but the market recovers and we get every penny of that $100,000 back, we're even. But emotionally, we don't feel even. We still feel like we lost money, and that can affect our decision making. That's prospect theory. And we try to show it there with that formula: fear equals 2 times greed, and that asymmetric line where the losses and the mental value attached is much sharper on the downside than it is on the upside.
Joe, what data can you share from studies about investor behavior? We understand you may have some cautionary tales.
Yes, some very cautionary tales. And to Bob's point, with losses looming larger than gains, and that the downside being much more painful, we're more prone to make decisions during those time periods that aren't in our best interest, right, by reacting. And the study that Deirdre's put up is called the Quantitative Analysis of Investor Behavior. It's created by Dalbar. It goes back to 1994, and it reflects all of the trading of all mutual. I'm sorry. It reflects trading of all of mutual funds by individuals, and it shows that those decisions are not in the best interests of the individuals, because in many cases, there are losses that are caused by those decisions. In some cases, significant losses over significant time periods. So if you're wondering how an investor can underperform their investment, it's because the two evil twins, fear and greed, that Bob just touched on, are introduced into the decision-making process. And we're all hardwired the wrong way. When we should be greedy, we're fearful. And when we should be fearful, we're greedy, right? At the market top, we're greedy. When we should be afraid, at the market bottom, we're the exact opposite. So we're buying it high and selling on lows. It's like the rinse and repeat cycle on the washing machine. But if you look at last year, the average equity investor underperformed the market by 5.5%. The average bond investor underperformed the market by 4%. Now, 1 year, we're all, right, everybody has a bad year, right? Best investment managers in the world have bad years. Warren Buffett's had bad years. But if you look at the last 20 years, over the last 20 years, the average investors underperformed the market by 2%. A compound 2% over 20 years, it makes a big difference in the amount of wealth that's accumulated. The average bond investor, which you would think would be an easier pill to swallow being invested in bonds, they've underperformed by 4.5% per year for 20 years. And it's shocking. And that's the reason, one of the primary reasons, well, the core reason, why having a strong understanding of behavioral finance, understanding the biases that Bob's going to go into detail on, and being able to avoid those biases by clearly definable and repeatable investment processes, it means it's going to mean a big, big difference for people's personal wealth, as more importantly for the institutions that they represent on investment committees.
Can you give us an example, Joe, of one of the behaviors that could trigger failures or this underperformance that investors experience even during frothy times?
Absolutely. Anchoring, right?
Right.
Anchoring to a piece of information that you have or to a price point, your purchase price, right? Markets are the collective opinion of all participants, right? The market doesn't care what you paid for something, right? To Bob's point, yeah, if your investment went down 50% and then doubled to get back to even, right? A lot of people are saying that prayer, right, when they're down 50%. Dear Lord, give me back to break even. I promise I'll never do this again, right? The market doesn't care what you paid for that, right? It may never come back. The whole idea is to evaluate the resources that you have invested in that particular investment and see if it's being held to the best and highest use that it can be, right? The past, there's no future in the past. And in the market, that's especially true. Because at the end of the day, it's about skating to where that puck is going, identifying what you believe is going to happen, not what's happened in the past. And there are so many different biases, anchoring being one. There's hindsight bias, where people are driving the car looking out the rearview mirror, right? About what has happened, not what is expected to happen. I mean, the reality is right now, the market's a discounting mechanism of 4 quarters to 6 quarters out. The market's already discounting what is expected to happen at the midpoint of next year. If you view this event that we're going through right now as a natural disaster, which Morgan Stanley believes is more the case than a systemic financial issue, natural disasters are ultimately, the risk is ring-fenced, it's addressed, and economies move on. So those are 3 very good examples. Drive the car looking out the front view mirror. Look forward as to what you think is going to happen, not based on the decisions you've made in the past. And you'll become a heck of a lot better investment committee member.
Thank you. So you mentioned anchoring and hindsight and recency, as did Bob. And Bob also prepared a really fascinating, I think, telltale slide for us. I'm just going to share here that frames volatility. Bob, could you take it away?
Yeah, thanks, Deirdre. This one, you'll see the headline is Framing and Market Volatility. And really, framing reflects how information is either presented to us or how we interpret it. And you think of the classic example of a glass of water that's half full or half empty. It's actually both. It just depends on how we choose to look at it. And here, what we did was look at the best and worst performing days in the S&P 500 going back to 1940. And what we tried to show here is that when markets are volatile, the best and the worst performing days tend to cluster. And we highlighted back in the financial crisis, 2008, 2009, those days in blue. More recently, we highlighted ones in green. So what happens when markets are volatile, sometimes people think, oh, I want to go to cash, I want to get a little more safe, and then maybe they see the market go back up, and now I want to jump back in the market and take advantage of these highs that are being made. Our advice would be not to do that. Just simply to stay invested for the long term. Because again, when markets are volatile, the best and worst performing days are clustering. And historically, that's continued right up until it hasn't. And I don't know when that's going to occur. And honestly, nobody does. So again, the best course we believe is to stay invested for the long term.
Thank you. We need advice here, gentlemen. What types of processes can our investment committees put in place to mitigate against recency and anchoring and hindsight and other biases?
Bob, you want to go first?
Sorry. I dropped the mic. Bob, we'll give you the word.
Both so deferential. I'll start. Actually, Joe touched on this a little earlier. It's having a thoughtful, rational process in place. So do you have a checklist, for example? And there are some decisions that bias can really sneak in. And I just want to highlight a couple of those. So if your committee is hiring or firing managers, if you're adopting strategies with recent success or choosing to get rid of strategies that have done poorly recently, if you're avoiding high-risk investments due to perceived volatility, if you're evaluating products like a mutual fund or an ETF without evaluating the organization, the firm that's sponsoring those products, that's where we can get into trouble. And one more I would add, anytime there's illiquidity or leverage involved, be really cautious of how you're making that decision. And I'll stop there. I'm sure Joe has more to share.
Sure. And Bob, you just touched on something that we're big believers in, which is doing operational as well as performance due diligence. Performance due diligence, anybody can get access to performance numbers. Understanding how those numbers came to be is a little more tricky. But in conjunction with that, understanding the organization, understanding what their, what the plan is if the senior person leaves, understand who the attorney is, who their accountant is, understand what their risk management strategy is. In this day and age, understand what their cybersecurity plans are, right? Can they protect your assets? Can they protect from being hacked? All of those things are critical because, as Warren Buffett said, you don't find out who's not wearing a bathing suit until the tide goes out. Right? And risk is never a problem until it presents itself. So you want to be mindful of understanding what potential risks there are so that you can manage through those risks as opposed to being blindsided by them and being forced to potentially make a decision that is not a well thought out decision. So we're big proponents of the investment policy statement, which should delineate roles. It should delineate the search, hire, and fire process of bringing on a new asset manager. It should highlight performance reporting and what that should include. As Bob touched on, and he can go into a lot further detail than I, about how decisions should be made so that you don't draw out biases within that committee, so that decisions are not being made on a level playing field. Asset allocation, right? Asset allocation is responsible for 90+% of the volatility or variability, of your returns. And because of that, asset allocation should be consistent with three things: your investment time horizon, your need for liquidity, and your tolerance for risk, okay? And when those three things are consistent with how you allocate your monies, you'll have a higher probability of better outcomes. In conjunction with that, policy statement might call for a side pocket of cash. And this, in days like this or months like this, the side pocket of cash creates a safety net so that short-term liabilities can be met with low-risk assets. Although there'll be a drag on a portfolio as markets are doing well, they will more than pay for themselves when you don't have to touch your risk assets in markets like this to meet short-term liabilities. So all of that, all of those things come down to creating definable and repeatable processes that can weather the storms that markets go through, whether they be it just standard market corrections or things like a pandemic that, frankly, who would have predicted 18 months ago?
Thank you, Joe. It's always useful to consider the liquidity sleeve over your time horizon, and we've heard you and others speak about having up to a period of 3 years of distributions and expenses for our parishes, for our endowments, to be in cash instruments and more conservative fixed income instruments. Does that still resonate?
Sure. Again, I would say it would depend on the risk tolerance of the organization, but I would argue it should be minimally 6 to 9 months, right? Average bear market lasting, or market going down 20% or greater, lasting 8 to 14 months. But if we were to get into an elongated period of underperformance and the committee's tolerance for risk was low, 3 years would absolutely be appropriate. So that, again, the risk assets can do what they need to do, which is weather the storms in order to generate those outsized returns.
Thank you. Bob, you have prepared this, it's almost an infographic, the Wheel of Investor Emotion. Could you please explain it to us a bit? We understand it's normally a physical wheel that you can move, so we'll just rely on your words to help us understand it.
Yes, thanks. We're always looking at putting the theory into practice. How do we make behavioral finance applicable, practical? So with this Wheel of Investor Emotion, it really puts prospect theory into play. And I want you to think of, first, a portfolio that would earn 15% a year for 20 years with a very low standard deviation of 10%, meaning the returns are pretty consistent over those 20 years. Now, honestly, I don't think Bernie Madoff had returns that good, but if you looked at this hypothetical portfolio every hour, every minute, or every day, there's only about a 50% chance that you would see a gain. Now remember, prospect theory says the other half of the time when you see a loss, you're going to feel twice as bad as when you see a gain. And that's what we were trying to show here with this wheel. It's turned to daily now. You see it at 54%, and we added these little emojis. So this is how you might feel. And this emoji looks a little nervous or a little upset. As Deirdre said, if we could turn it to monthly, you would see the likelihood of seeing a gain goes up. It goes up even more at quarterly. If you looked at it once a year, there's like a 93% chance that you'll see a gain. So you would feel great about this great performing portfolio. What this tool is designed to do is to remind us not to look so frequently. And I know that's hard in this era of smartphones and tablets and laptops where we can check our portfolio balances every minute, every hour. But I would really urge you not to do that. That is so inconsistent with long-term investing. And again, once we see those losses, it can trigger all these emotional biases that can, again, adversely affect our decision-making.
Well, thank you. I think checking a portfolio daily or intradaily is clearly, you're sharing with us unhealthy behavior, and it could create a poor emotional health index. So I do appreciate, I find this fascinating that even in your example of frothy performance, that checking too often, I suppose it creates and increases anxiety. So let's get a little bit more into your decision theory. You're sharing with us how we make decisions. And Bob, this is for you.
Yep. As we've touched on here, there's a number of biases that can affect individuals. And then there's some new biases that get introduced when individuals are acting collectively within an investment committee, for example. And those two, the biggest ones to me, are groupthink and confirmation bias. And I can talk more about those later. But essentially, how the group makes its decisions is so important. And when I share this with investment committees, a lot of them are unaware of something called decision rights. How do we decide? And this chart just shows a range of decisions, which might start at the lower left with the leader. So your chief investment officer, a board chair perhaps, he or she has the sole right to make a decision. And as you move up the scale, it's leader with input, et cetera, et cetera. If you don't tell people how a decision is going to be made in a meeting, they tend to think it's going to be a majority vote, even if there's no vote on it. So I think it's essential to say, in the case of leader with input, The leader may say, I want to solicit your feedback. At the same time, I have the final say in this decision. So I think using this tool can really enhance the decision-making of the team just by clarifying how the actual decision is going to be made. Oh, I guess this is my cue too. Yeah, this is a big one. This is from a piece that we did years ago on the 4 drivers of success. And with investment beliefs, this is so critical. Is everybody on the same page? And the biggest one here to me is, what are the best investment opportunities that the organization can capture? Where are your skills? Where are your talents? What are you trying to do? And how can you best accomplish that? This also could encompass things like return expectations, the importance of fees, how frequently do you rebalance the portfolio? What's your investment time horizon? What's your take on active versus passive management? Those types of things. We want an organization where the beliefs are shared. 2, governance, just a couple things there. I was asked by a committee to come and talk with them individually, and they really wanted me to highlight the difference between governance and management. And I said, governance is doing the right things, making sure the organization is focused on those beliefs. Management is focused on doing things right. And I'm not saying that a board and an investment committee shouldn't talk to one another. They should. It's just you want to have a delineation between those responsibilities. I often think of it, I'm a big sports guy. Like, you don't want the owner of the football team on the field telling the coach what plays to call, okay? And then the last couple, aligned interests, I can talk more about that later, kind of self-explanatory. And then people. Are the people within the organization or the committee long-term focused? Are they team-oriented? What's the leadership like? And the biggest one, culture. Do you have a good culture within your committee that's going to hold all of these aspects together?
Bob, you've talked about a few biases today. Which would you say is the most dangerous right now? And what are some ways we can protect ourselves?
Right now, given what we've talked about and how volatile the markets are, I think it's extrapolation, where we see something in the short term and we just think that's going to continue or even accelerate in the long term. That can be really, really damaging. And with most, if not all of these biases, it's not allowing that emotional element to affect the decision. So it's driving all the decisions back to the investment policy statement, to procedures that you may have, to a checklist, because investing tends to be simple, buy low, sell high, but it's not easy. And it's these biases that get involved and can affect our decision making. Working with a consultant, an independent third-party professional, that also can really be a help, because it's hard for us to be unemotional about the money that we're managing. So getting some help from somebody, that's often a great tip too.
Joe, what should our investment committees be focusing on? And is our focus to be any different from any other time?
No, the focus should be on the mission of the money, aligning the money with the organization's goals, right? And making sure that it's being done in the most cost-effective way to generate the best risk-adjusted returns. You know, the fact is, we as humans love to find patterns, right, and tell stories. The old saying is, the one constant on Wall Street is change. Every day is different, right? Wars happen, natural disasters happen, government intervention happens, there's change in tax law, right? Securities industry regulation. The focus should be on, again, that alignment with the idea that being adaptive as things change and not anchoring to what you did that always worked, or not, again, hindsight bias, not looking, confirmation bias being another deadly bias, right? I could have the craziest idea in the world, and I'm sure if I go on the internet, I'll find somebody just as crazy as I am, right? That will confirm that I'm right. So you need to be careful with that. And again, just, understanding what you know and understanding what you need to know and don't know, and then pulling that together as a committee and optimizing the resources of that committee, right? The strengths of that committee to be able to put the monies of the organization to its best and highest use. And not, there's an old saying too with committees, right? It's an old Jamaican saying, the emptiest drum beats the loudest, right? And that's coming back to Bob's talking about, decision-making process is critical because you don't need the emptiest drum in the room pushing their agenda on everybody just because their Uncle Bob at the 4th of July picnic told them to do something, right? That is no business being anywhere in an investment committee meeting, right? And that comes back to that whole process. So to answer your question, it's kind of the same old, Deirdre, with the whole idea that, change is always upon us. A couple of years ago, we only had 8 days when the market moved up or down 1%. The average over a calendar year is 70 plus days. So volatility is coming back. And volatility does what? It creates anxiety, right? We all know that. Creates anxiety, and fear and greed come and present themselves, and it can cause a string of bad decisions, or a myriad in some cases of bad decisions. So having that process in place, understanding what the purpose is, and you know what, sometimes you got to get in the corner like Muhammad Ali did and cover up, right, just to catch your breath and come back out, because the market, there's an old saying on Wall Street as well, stocks take the elevator down and they take the stairs up. When the market goes down, it goes down a lot quicker than it goes up, about 2.5 times quicker. So when it happens, you better understand why it's happening, what it means to the purpose of what you're trying to accomplish, and keep those goals in mind.
Thank you, Joe. Bob, how much of a difference can understanding biases really help my investment committee?
I think it's huge. And I think just awareness, again, of some of these biases and the moments or the points at which we make decisions can help keep us on track. Joe touched on a couple of things I want to expand on a little bit when it comes to teams and their diversity. Because I touched earlier on beliefs, and the team should have shared values and a shared belief. And recently there's been a move toward more social diversity, which I think is great. Race, ethnicity, gender, age, etc. But you also want a team that reflects cognitive diversity, different ways of thinking about things. That's the real advantage that teams bring. And investing money is ideal for a committee to do. Some tasks aren't. When's the last time you read a best-selling novel by a committee? Probably never. That's an individual act. But committees are ideally suited to bringing in different ideas, different perspectives. But if we don't allow the members of the team to speak up, if the loudest drum in the room always gets his or her way, that's not effective. So there's got to be a sharing of ideas so you can really benefit from the diversity in thought on that committee.
That's a perfect segue into my next question for you, Bob. We could actually have an entire session on any one of these biases, and I certainly think confirmation bias is one that you mentioned earlier. We've seen recent studies that boards and committees make better decisions when they are diverse. It can even, that diversity can even contribute to stock performance, according to some studies, which I'll be happy to make available to interested parishes. So it brings up a question about how biases affect investing behavior differently. And just for kicks, is there, for example, a difference between men and women when it comes to investing decision-making?
Actually, yes. I would preface that by saying most of these biases affect people generally the same way. There have been some studies that show that women tend to be more patient than men, and thus tend to be better investors. And I often think of the sitcom Seinfeld, when he talked about how men and women watch television. And he said, men are not interested in what's on TV, they're interested in what else is on TV, okay? And it's similar with investing. Guys, we tend to look for the next best thing, the next biggest thing. And again, women are a little more patient. So balancing that out, bringing in a woman's perspective within the investment committee structure can be really beneficial long-term.
Joe, any comments you'd like to add to that? I know that you're a proponent of being a patient investor for long-term, more risky assets.
Yes, I mean, again, there's three ways you can be successful investing, right? One is be luckier, right? Or be lucky, and that's not a great plan. The second is be smarter, and being smart is not always a guarantee. We've seen, very smart people blow up, companies like Lehman Brothers who financed the North in the Civil War, okay? Or you could be patient, right? And being patient is something we can control ourselves, and being patient by understanding what markets do and how wealth is created in markets is something that a process can be built around that can help generate more attractive rates of return with lower risk over long time periods. And by having that in mind, reacting to Bob's earlier point about looking at things on a day-to-day basis, well, if those assets are meant to fund liabilities over the next 30, 40, 50, however many years, day-to-day market gyrations really aren't critical, provided the assets are allocated properly and consistent with, again, tolerance for risk, time horizon, and need for liquidity. So, end of the day, it's just coming down to understanding what the biases are. And again, there's so many different biases. We could spend, the next 3 weeks discussing all of them. But, understanding, how these processes fight these biases or push out these biases that we all bring to the table, whether it's home bias, right, which is, well, I'm only going to do things that, are here in the United States. Well, that's great, but 75% of the world's, value of stocks is outside the United States, right? We're giving up all types of opportunities by being subject to that particular bias. Disposition effect, right? Holding on to losers and selling gains, right? Things that have gone up in value. You end up with a portfolio full of losers. And that's no way to create wealth. So again, just getting your arms around on these types of things at the end of the day will make and do make people better investors.
So Joe and Bob, one thing we know, and the reason for this webinar, is that people in financial roles at our parishes need to be mindful of how to make good decisions. What are we to do if this is an area of weakness? And Bob, you have a slide on evaluating success, so you can get to it in your own rhythm, but I do want to go ahead and have that up for you for reference.
Yeah, I would just echo some of the things we've talked about earlier, working with a third-party professional, driving all of your key decisions back to your investment policy statement, having clear procedures for doing things, checklists even. All of those things can keep us more rational and less emotional. And then within the group, there's some things that we can do where the leader may want to call on each person to get them to speak up, to make sure that diverse opinions are being shared. How you vote on things. I've worked with committees where I've asked, how do you vote? And they look at me like, what do you mean, how do we vote? And I want to know specifically. And they'll say, well, we'll take a show of hands. Well, sometimes there's pressure within the group to conform to what others are thinking. And now with things like Slido or Poll Everywhere, you can literally have people within a meeting vote with their smartphones anonymously. And you might get a very different discussion if you do that versus a straight show of hands voting technique. So that all ties back to this slide that we've got up on the screen, where I always stress to committees, drive everything back to your process. The outcome, the results, that should follow. So in this example, if you have a good process and a good outcome, hey, high fives all around, that deserves success. But you can have a good process and a bad outcome, especially in the short term. That's just bad luck. Now, conversely, if you had a bad process and a good outcome, that's dumb luck. I don't know if anybody plays blackjack, but you're sitting at a table and the guy next to you has 18 and the dealer is showing 6. And the guy says, hit me. Like, really? And what does he draw? A 3, right? Wins the hand. That's a terrible approach. And if the guy plays that way, he's going to lose all his chips. It's just a matter of time. But you can get a little lucky. But a bad process and a bad outcome, that's just poetic justice. So Joe touched on this earlier too. Focus on the long term. You have a good process that's grounded in a good investment philosophy. That should pay off. All these biases are really just different ways that fear in the short term rattles us out of an otherwise sound long-term plan. Just don't let that happen.
Always good advice not to operate from fear. So easier said than done, but we'll take the tip. So Joe, one has to be an ostrich not to expect poor signals in this economy. Yet we also see rally activity. We wonder, when will we get an all clear? Some of us would rather not even watch these headlines that aren't even headlines anymore. We have seen investors start bottom fishing. We have seen some portfolios that went underweight in equities and may have felt the need to do some rebalancing. And we've also, lastly, seen traders who may have been looking for a bounce. We heard from you about visibility into the severity of this recession and some scenarios for the geometry of the recovery in our webinar with you a month ago. What can you share with us? And do you see any difference to what you shared a month ago in terms of assigning a shape to our economic recovery?
Well, our thinking is that the second quarter of this year is going to be the trough of what's happening. We're viewing this as a natural disaster type of event to the economy. And the risk to all of these things is when this virus is under control, right? Our biotech analyst has been in contact with the Johns Hopkins Research Center for the coronavirus virtually on a daily basis. And our thinking, again, based on that research, fed back to the economics team, our belief is Q4 will be stronger than Q3. We think there'll be a global contraction this year, which didn't happen in 2008. And we think the U.S. economy will be down 5% this year. We think the U.S. economy will grow by 5.5% next year, that China could grow as much as 9% next year, and that the globe will grow somewhere to the tune of mid 5% range or area. So with that being said, let's not lose sight of the fact that stocks are a discounting mechanism. They're the present value of future earnings and dividends. And the market's already discounting the first quarter of next year, and soon we'll be discounting the first 2 quarters of next year. So our feeling is, and if I may, we're looking at a V, right? We think we're in a V here, again, with the idea that this virus is under control by the end of the year. So with that being said, we think it's constructive to put money into stocks if you've got money on the sidelines, okay? One area which seems like it would be putting your hand on a hot stove, small cap stocks, right? The last time we had the market down, the last 8 times the market was down 20% or more, small caps outperformed over the following 12 months. So think about all the domestic stimulus that's put in place, and the fact that correlates directly to helping small cap stocks greater than helping large companies that are doing business all around the globe. So we're constructive. We're constructive on high yield, right? Junk bonds. They were yielding more than 10% greater than their comparable high grade or investment grade bonds. The last handful of times that's happened, junk bonds have done very well the following 12 and 24 months. So there's an old saying, never let don't let a good crisis go to waste, right? Crisis creates opportunity is the old Chinese proverb. And there are opportunities that have been created and will be created as a function of what's going on. So again, as an investment committee, you would want to be mindful of where those opportunities are being created. And that's a great chart that Bob just put up. You can have a great process in place, and unfortunately, it doesn't always create the best outcome that you're looking for. But if you've got a good process in place, you'll have more good outcomes than bad outcomes. And those good outcomes should outweigh and create a range of acceptable outcomes. So with that, again, there are opportunities being created. And frankly, there are things, right? This is going to change behavior, and this is going to change some industries forever. Some for the better and some for the worse. So don't anchor to what used to work, right? Look forward and make those good decisions, or make those decisions based on good process, and stay diversified. There's an old saying, being diversified means always having to say you're sorry about something, right? There's always something that won't be doing as well, but at the end of the day, that's going to get you to where you need to go with the least amount of angst caused by that roller coaster ride that nobody likes when you get to the top, right? Which is that fast ride down when you feel like, it's never going to stop.
Thank you for those comments, Joe. I hope you're right about the shape of the recovery. I'm certainly hearing of all the geometry of the V and the U and the L. And so what I would like to ask is if you could share for our attendees what open source, not necessarily just for Morgan Stanley clients, but where can we go to learn more about Morgan Stanley's outlook for both the market and for the economy, as those are not always going to be acting in tandem with one another. I mean, we know that the market reflects the health of the economy, but as you've already said, and as Bob's chart showed, the market will recover ahead of the economy, right? If we're waiting until the economy gives us the all clear, the market will have already priced much of that in. And so we want to continue to be educated. So please share some sources or resources that you can with us.
I believe Morgan Stanley Online will post some information. We've got the intellectual capital at our firm is very broad. You turn to CNBC, Bloomberg, all the Fox Business News. There was Morgan Stanley Daily week. So that would probably be the easiest way to be able to access it on a very broad basis. It's again, there's a lot. Everybody feels like they're drinking from a fire hose here as well, and that's one of the things that investment committees have to get through too, by kind of focusing on what they need, what they're trying to accomplish.
So can we find this on morganstanley.com, or is there a specific publication to be telling people about?
Well, if they wanted particular research, they would have to go to their Morgan Stanley advisor to be able to get that particular research sent to them. As far as kind of broader comments, those would be sometimes they're posted on morganstanley.com and others just through the general press.
Okay, thank you. Thank you, Joe. Before I turn over to Bob and have him share some books, some reading resources, and some of his other ideas for we can learn more about behavioral finance and economics, one of our favorite questions for you, Joe, is always, show us your Venn.
That's a beauty. It's Carl Richards, who writes for the New York Times. He sent that to me, and he and I were planning on teaching a behavioral economics class at NYU together. So it boils it right down to what an investment committee should be doing. Things that matter, because if it doesn't matter, why bother with it? And things you can control. And the market is something you can't control. It's the collective opinion of all participants. And those participants, we know from time to time, can be incredibly irrational, right? Which comes down to herding bias. Just because everybody else is doing something doesn't mean you should do it as well, right? Everybody's mom told him or her that in grammar school, right? When kids were doing stuff that got them into detention. So focus, find out what matters to your organization, understand what you can control. An example of that is your asset allocation, right? You can't control what the market does on a day-to-day basis. And then focus on what overlaps between those two things, and you'll become a better investor. You'll absolutely become a better investor.
Thank you, Joe. And I would just add that we all need women on our investment committee so that we can have that infusion of patience to assist us in our long-term goals. Okay, Bob, I'm going to turn it over to you.
Hey, just one thing I want to stress. When there is volatility in the market, often the circumstances are slightly different, maybe very different than the last time we had a market downturn, and certainly a global pandemic. This is a new one. But if you think back to the great financial crisis, the tech stock bubble, 9/11, even going back to the recession in 73, 74, they all share similar traits. And we touched on that a little bit with extrapolation and fear and greed. There's this cycle from highs to lows. And I tend to firmly believe that in the short term, markets move up and down, but in the long term, they move up. And I always bring this up when people say, particularly about equity investing, because they perceive that as so risky. And folks will say, I don't like investing in the stock market. And I often say, I don't like investing in the stock market either, because it's a reflection of so much emotion. But I do like investing in individual companies, and accessing them through the market is the easiest way to do that, because equities, to me, you're really not investing in stocks, you're investing in ambition. You're investing in innovation. And I will own companies that are ambitious and innovating every day, no matter what the market is doing. So again, it's hard to keep that in mind when you're in it, but history has shown, again, focusing on the long term, sticking with your process, having a good plan pays off over the long haul.
Thank you. I would like to ask Joe if he has any final comments for us as we begin our wrap up.
Yes, I do. We are all in the day and age where we are constantly bombarded for donations, right? I mean, there's not one of us on this call who doesn't every week get a handful of envelopes asking for money. And in front of us right now, over the next 2 decades, is going to be the largest transgenerational wealth transfer in the history of the world. It's $68 trillion. Right? Now, it might be a little less today than it was last month, but it's an enormous amount of money. And make sure you get your seat at the table, okay? And I can tell you a way not to get a seat at the table is by having an ad hoc, haphazard investment process, okay? You may get lucky. I mean, you may have a bad process and a good outcome, but you don't want to be that person taking the hit at the blackjack table when you're showing 18. Right? So a way to instill confidence in your donor base is to have a tight process, to be able to show a donor an investment policy statement that's well thought out and is up to date, right? To be able to show the type of decision-making that your committee has done both in good and bad markets, and how that's benefited the organization that the donor is inclined to donate to because of the passion that they have for the organization, right? The connection that they have to the organization. And they're being hit up by the school they went to, they're being hit up by the SPCA, the Red Cross, I mean, you name it, right? If I saved my mail, and I used to do it, I'd show people a stack like that over the course of 1 month. Make sure you're at the table. Make sure you're at the front of the table where you're top of mind, so that you share in that wealth transfer to be able, again, fulfill the mission of the organization in perpetuity.
Thank you. I'm so glad that you brought that up because we do have to be mindful of our own growth as we all wish to expand our mission, right? And so this is going to be something that helps us as we further develop and fine-tune our processes and communications with our parishioners and with the friends who also donate to our missions. Bob, I'd like to ask you to share some of the resources for Brandis Institute, which some of us have been introduced for the first time as a result of your participation on our SEEP webinar today. And I understand you have a YouTube channel.
We've got, thanks Deirdre, a YouTube channel, we're on LinkedIn, we're on Twitter, and you can always go to the website, which is simply brandis.com. There's a link to the Institute there. There's no login or password required. So a number of the studies that I referenced today are there in their entirety. And I'll also offer myself up as a resource. If you have questions, comments about anything that I've discussed, feel free to reach out to me, connect with me on LinkedIn. However you do it, I'm happy to help.
Thank you so much for that. And I am just posting, your Twitter link is at Brandis Institute, and it's the same search for YouTube in order to find the goodies that you can make available to us. We really appreciate all of our attendees for joining us today. We especially appreciate the time and talent provided by our friends, Joe Matthews and Bob Schmidt. And with that, the SEEP Network thanks you all for being with us today. And we'll see you on our next round in 2 weeks. On May 4th, we're going to be discussing the vital time for place-based investing with community capital management. Thank you all.
Thank you.